The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Bonnie Quinn. We are kicking you off to the closing bell here in the United States.
A day where we're seeing stocks at a record high despite an inflation report, a consumer inflation report that continued to show an increase in prices, but it was where those prices increases came that apparently is injecting some optimism into the market.
Exactly. Services, airfares, for example, and you see airlines really topping the list when it comes to those gains today. But look at the Russell 2000 as well, Romaine, up 2.6%. Small business optimism above 100, really bouncing back in July.
And that's where we start our show here with the headline CPI number coming in at about 0.2%. That was right on the nose of economists' expectations. Core CPI coming in just a little bit higher on a year-over-year basis, but there's a lot of talk right now about the complexion of this report and what we should read into it. Omair Sharif kicks us off to the close, founder and president of Inflation Insights. And Omair, when we take a look at these numbers, the refrain that I'm hearing so much is this idea that you had a reduced disinflationary impulse for services, but you still had some degree of disinflation when it comes to goods. What was your take?
Yeah, thank you for having me on. Look, I think core goods obviously moderated a little bit. So if I want to look at core goods outside of the auto sector, and I'll come back to autos in a second, but last month we had a 0.5 reading. That was the highest since sort of the early 2022, COVID era prints, and today it's slowed down to 0.2. So I think some people are going to take relief from that, saying maybe tariffs are not being passed through the consumer. But I would be really cautious about that view for a couple reasons. First, when you look at core goods in the month of July on an unadjusted basis outside of autos, they typically tend to decline quite a lot in July. So historically, they've fallen by about 0.5 in July. Today, they were flat. That tells you that relative to history, we actually had some strength in core goods and tariffs were likely being passed through. The second thing I would mention within core goods is that we still had a lot of items going up today. So, something like household furnishings and supplies, this is stuff in your house, carpets, furniture, appliances. It actually, 11 out of 17 items went up versus 15 last month. Mm-hmm. So you're still getting a lot of broad-based increases in core goods. So I would not take a lot of solace on core goods just from the fact that they slowed. And as you mentioned, core services actually picked up to 0.4. And that's been a big theme of mine, is that core services in the second half of the year are actually probably going to be firmer than the first half. So you're not going to get that offset from core services that you might have expected in the first half.
Well, what I'm curious about then, is this sort of a sign in this report, and I know we're going to get PPI tomorrow, which will give us a better read on the wholesale side of it, is it the idea that we are seeing cost pressures, high, increase in costs, but those costs, at least for right now, are being contained by the importers, by the companies themselves?
Yes, I would say absolutely less on the importer side. Really, the only item I could point to where, you could say importers are, quote unquote, eating some of the tariffs is in apparel, where we have seen import prices of apparel come down, but it's not really happening in most other items like furniture, appliances, for example. So there is some of that is being absorbed in the margin. I think most famously for new vehicles by the automakers, we know that they've lost billions in the last quarter due to the tariffs because they're absorbing them right now. But we've seen, for example, the 3-month annualized rate for things like furniture pop up. So household furnishings and supplies were up 1% in June, still up 0.7 today. So you're still seeing the pass through to the consumer. And I would say, most economists really expected this pass through to begin this summer. Because the global tariffs only came into effect in April, and obviously we've kind of whiplashed quite a bit on that number. But right now, June, July is when you expected the stuff to start to come through. Right. And I think the data the last 2 months shows that it is popping through.
So then how much does this actually clarify things for the Fed, Omair? What do we know about future inflation reports that the Fed can maybe act on in September? Is it a foregone conclusion that we get a rate cut?
Yeah, look, I think the labor market is probably a little bit, more heavily weighted in the Fed's calculus right now. If you get a bad number in the next report before September on the labor market, then I think probably it's very likely as the market's pricing in. But I would say the inflation data is pretty mixed now because you've got some tariff pass-through coming in June. A little bit came in July. I still think it's relatively broad-based. I expect to see more. So as an example, Procter & Gamble have already said they're raising prices for a third of all of their goods in August. So there's more in the pipeline that's going to come through. But now you've got core services kind of joining the party. And that is, I think more troubling from the Fed's point of view because they've been sort of banking on core services, which have been weak the earlier part of the year, to kind of continue to offset any sort of tariff-related inflation. And my argument for a while has been, look, a lot of that in core services was in airfares. We know that mix is changing. Demand has kind of stabilized. You've heard the airlines say that. And more importantly, from my perspective, they're cutting capacity into September, which means less discounting. You saw airfares jump pretty significantly today. I think that's going to help drive core services in the second half, which for me, that's just not a good mix of core services rising and more tariff pass-through to come later on this year.
Yeah, airfare is up 4% today. Omair, thank you so much. Much appreciated. Omair Sharif, founder and president of Inflation Insights. For more now on the market reaction is Seema Shah, chief global strategist with Principal Asset Management. So, Seema, the market seems to like this, also liking the small business optimism idea, but there's a lot to be frightened of out there, right?
Hi, Bonnie. Thanks for having me on. I think that there are concerns out there, maybe because we had a lot from Omair there, that there's going to be continued pass-through of tariffs to core goods prices at the same time that you're already seeing upward pressure on core services. So whereas it seems like a foregone conclusion that the Fed is going to start cutting rates in September, that decision-making process does become a lot more complicated as you get through the rest of the year and certainly even into 2026. But from a market perspective, what I think they're seeing is that, look, there's no real concerns about the state of the economy. Yes, there's a slowdown, but in terms of recession risk, it's fairly low. And yet you're going to get preemptive Fed cuts, and that really creates a constructive backdrop for risk assets.
That said, earlier UBS was on telling me that they're actually expecting negative job prints by the end of the year and that the labour market could deteriorate significantly. And particularly if we're seeing services inflation up this much, Seema, isn't that a real risk that the consumer will just be very, very hit towards year end?
I think there's a risk, and if the labour market report, if you did start to see negative payrolls, well, that's a very different picture. We're not anticipating that. When we look across the balance sheets of consumers, of corporates, we don't really see any major tensions there, which would suggest that job cuts are really necessary. And at the same time, we've seen the NFIB, the Small Business Index survey pick up. So we're fairly sanguine. There is a slowdown, as I said, but we're not anticipating this really major deterioration in the labour market to come through over the next couple of months.
So square that, though, Seema, with where we are with regards to valuations. I mean, we talk about a market at a record high, but when you look at the individual names, the idiosyncratic names, we're talking about multiples and valuations that certainly in recent market cycles are almost unprecedented. And I do wonder what 1, 2, 5 rate cuts even does for making those valuations actually look more sensible.
Right, and I think investors are becoming more and more concerned, a little bit more aware and cautious because of that valuation perspective. But it's important to remember that valuations don't necessarily mean that there's going to be a correction. It means that there's going to be vulnerabilities if and when fundamentals start to deteriorate. The other thing it does, it provides a bit of a speed limit for the economy, for markets. So from our perspective, we're constructive about the risk asset outlook. But we're not expecting very meaningful gains over the next year. Really, this is like low single digits that we're anticipating, partly because of those valuations almost mean it's very, very difficult to see that continuous increase in a lot of these asset classes.
I am curious, though, too, when we get past equities. I mean, yes, we have a record rally today, but you look at the weakness in the dollar today. You look at some of the weakness we're seeing in commodities. Commentary by the new BLS chief about potentially suspending the monthly jobs report, at least temporarily. Comments from the president, once again, criticizing the Fed. And you have a risk, at least for the markets right now, when it comes to the reliability of data and, more importantly, the integrity of the U.S. institutions that are there to collect and disseminate that. How does that factor in to your longer-term outlook, Seema?
Yeah, that is a very, very key factor that we need to consider. As you said, there's concerns around the integrity of the data. There's concerns about the independence of the Fed. These factors all piling up, and you're really seeing that show through in the US dollar, which is why you're seeing that continued weakening. It is something that we're watching very carefully. But again, what we do expect to see is that this really shows up in pushing up term premia. Does it push it to a point where it really starts to challenge equities, start to challenge equity valuations? I don't think it's going to get to that point. But you're right, absolutely, that this is something that we need to keep a watch on. And to me, the real concern is going to sit on the currency. So watching how the US dollar performs over the coming months will give us a pretty good indication of how bad that credibility is moving.
Yeah, it'll be interesting. The dollar on the back foot today after trying to stage a little bit of a rally off of those year-to-date lows. Seema Shah, Chief Global Strategist with Principal Asset Management, helping us kick you off to the close here on what could be a record-setting day for equity markets. But when we come back, we're going to talk private markets. We're going to talk venture capital and the counterweight, the potential counterweight to the college funding crackdown. We're going to talk to John Flavin. He's the CEO of Portal Innovations about his new $100 million fundraise geared at university-based startups in the biotech sector. Stick with us. This is The Close on Bloomberg. A lot of talk about the Trump administration's crackdown on federal research funding. But that crackdown is creating an opportunity for venture capital. The biotech-focused firm Portal Innovations just announced it's raising $100 million for its third fund geared at university-based startups. I'm pleased to say that the CEO of Portal Innovations joins us here in Studio 2 in New York, John Flavin. John, great to see you once again here. You've already had 2 fundraisers, kind of in the same ballpark in terms of dollar value. Talk about the appetite right now for a third fundraise, particularly given that this is coming at a time where so many people are looking at the university pipeline, and more importantly, the federal funding pipeline, and are a little bit concerned as to whether there's going to be anything to fill the potential void.
Well, I think people see the need. What's happening right now is, through all the noise and change, there's really something deeper going on right now, and that is, bringing a drug to market, bringing a device to market, building a biotechnology company is going to look a lot different in the next decade, the next 20 years, than it has for the last 50 years. With new tools, new concepts, great innovation coming out of our universities, but converged with not just chemistry and biology, but AI and quantum and batteries for med tech applications. So we're seeing, very strong need by an increased number of universities that want to increasingly look to the outside earlier in the process to begin to form companies, move them downstream, and increase the chance that the translation of the idea at the professor's lab on campus can be translated into a company that ultimately helps patients at the end of the process.
One of those partnerships is with the University of Chicago. You're based in Chicago, although you have operations in other cities as well. Talk about that relationship and what the goal of that relationship between Portal and the University of Chicago.
Yeah, the University of Chicago has recently opened Hyde Park Labs. So it's a beautiful new facility in downtown Hyde Park on 53rd Street. It's part of a long-term strategy that began a decade ago to attract and retain high-powered faculty that are interested in not just doing great science, publishing that work in Science and Nature, but they want impact. And impact for them means they want to start a company around their idea and they want to treat a patient. So the partnership we have with them is providing our laboratory capabilities, and it will not only be life sciences, but quantum and battery at the same time, and AI. It allows that first step out of the university toward the marketplace that you can make a lot of mistakes in that first year of life. And so Portal is there to really bring the market perspective in early. And by doing that, you can improve the regulatory plan, the application of this new drug, and think through what it's going to need to look like after many years of development. And so that partnership will allow us to retain those faculty in our ecosystem and allow them to continue to repeat their innovation.
Now, you started 5 years ago, so you're not just in Chicago, you're also Atlanta, Houston, Boston, but outside the traditional life sciences area in Boston. I'm curious, has the focus of any of the companies that are in your geographies shifted at all since the elevation of Robert Kennedy, for example, or since the Trump administration came to power?
Well, if you think about the aspirational comments that have been made by Dr. McCary, they're very favorable to the biotech and pharma industry. I mean, his ambitions are to improve the throughput, shorten the timetable it requires to get through FDA clinical studies, imagining new types of protocols that might accelerate the drug approval process. So on the one hand, it's encouraging, and that's the long view that Portal Innovations has as we think about the opportunity to invest. Now is the time to invest because things will stabilize over time. Ambitions will be met in some form. And the thing is that, diseases like cancer and Alzheimer's, they don't know the difference between blue and red. I mean, the innovators on the front end are looking to cure patients on the back end. That isn't going to change.
Well, that's optimistic. Now, there's 112 companies across your campuses, but you've invested in, 26? What's the bar that those companies have to meet for you to actually invest?
Well, they have to have really solid intellectual property, so the patent needs to be defensible. they have to be working on science that we think is commercializable. It's an application that has some value in the marketplace. And remember, not all science is designed to be commercialized. Basic science is really important as well. In fact, I was reading a stat earlier in the week. NIH funding historically, if we look at the last decade, of the 300 or so drugs that were approved by the FDA, about 1.45 billion goes into a successful drug by NIH, and about 2.2 goes in by industry. So basic science is really important at the front end of that process. But if you look at the profile of companies we're looking for, it's breakthrough science, big market opportunities, rare disease opportunities where smaller markets, where new business models can be imagined to improve the treatment of patients that have rare genetic diseases thanks to new technologies like CRISPR and gene editing that are already having an effect on patients.
But you bring up CRISPR and gene editing. I mean, how do you square that, though, with some of the pullback we've seen by the U.S. government? For example, the recent edict by RFK Jr. about mRNA vaccines and basically suspending the council that would oversee that. And mRNA technology, as you know, goes way beyond COVID, has really the potential to treat cancers and a lot of other deadly diseases. And I am just curious as to how you kind of square that circle.
It's difficult in the short term. We know, and are rock solid in our belief that the science that brought us mRNA and platforms like CRISPR and tumor infiltrating lymphocytes, all breakthrough medications that are having profound effects on patients are required. And so confusing, but I think we're trying to take a longer term view that confusion in the short term does not mean that innovation can't break through, and we want to be there on the back end to support these innovators.
So just to be clear, over the last few years, we've seen remarkable advancements, the speed of which we got a COVID vaccine out, a treatment for sickle cell anemia, something I never thought I would see in my lifetime, several other things. Do you think as you look forward over the next 5, 10, 20 years, we're going to see those types of advancements and maybe even something even greater?
There's no question in my mind. I think the only thing that will be interesting to see is where will all that innovation occur. It may not be as concentrated in the U.S. as it has been in the past, right? But that doesn't mean there's not an opportunity to cure patients worldwide. So when I look at some of the companies forming at University of Chicago, for example, they're applying quantum and quantum sensing to biotech. We're still trying to figure out what that even means. I'm not a scientist, but the reality is, just like AI has had a transformative effect, on our society, the same will happen with quantum and new battery technology. So I have no doubt that we'll be able to see transformative breakthroughs even beyond what we've seen so far.
Fascinating, John. Absolutely, best of luck with the closing of the latest fund, expected to close before the end of 2026. That is John Flavin, Portal Innovations CEO.
All right, coming up here on the big program, stick around. We're going to talk about China and the requests that they have made to their companies to stop using NVIDIA chips. We're going to give you the explanation behind that when we come back. This is The Close on Bloomberg.
China urging local companies to avoid using NVIDIA's H220 processors after the Trump administration reversed an effective US ban on such sales. Joining us now to discuss is Aaron Rakers, Technology and Services Senior Equity Analyst at Wells Fargo. Aaron, does China even need these anymore? Does it have the technology that can compete by itself?
Yeah, I mean, I think AI is clearly proliferating, not just in the US, but globally. So, yeah, I mean, the short answer would be yes. I think China does need this compute capacity or capability. I think, the question that's going to come up on NVIDIA's earnings call in a week or so is going to be, the progression of demand as we move forward, the competitiveness of Huawei chips, particularly within that China market. But overall, it's a company that was doing, call it all in about $7 billion of revenue a quarter prior to the ban in April. They guided this quarter to about an $8 billion contribution from China, and obviously stripped that out of their expectations. And the question now is, does that come back, and what's the pace and the durability of that demand coming back as we look out over the next couple of quarters?
I am curious, though, Aaron, about this idea of whether we should start to model in maybe some potential hit, not only to revenue, but to the bottom line, both for NVIDIA and maybe potentially for AMD, if China does indeed pull back in a meaningful way.
Yeah. I think, honestly, we don't know yet, right? I mean, the company's in a quiet period going into their earnings. Obviously, AMD, when they had reported a week or so ago, they did not include any of the sales into China in their guidance. So I think AMD was around $1.5 billion of revenue lost this year. I think we will clearly start to build that back in. We did increase our NVIDIA estimates earlier this week, trying to take a stab at putting some of the China numbers back in our model. But we've really got to hear from the company at this point. And we talk a lot about the H20 chips. I think that the next question would be, what about the Blackwell generation? Do they get, as the Trump administration suggested the other day, is there other products in future generations that get kind of de-spec that can be sold into the China market? So NVIDIA's views of that durability, not in these just next couple quarters, but looking out into next year, will be an important point of focus for investors.
Yeah, Aaron, the president used the word obsolete when he was talking about the H20s, basically, and talked also a scaled back version of the Blackwell. Can you gauge the usefulness of these as time passes? Are they still extraordinarily useful to a country or a company, for example, or do they lose their value?
Yeah, I think it's not as much about losing value, it's about staying competitive, right? Can you stay on the bleeding edge relative to the internal China efforts, again, particularly Huawei's chips, and the continual development of that? These are products that are coming out on a cadence of every about 12 months now. And so, as those get kind of scaled back, can you remain competitive in a market that isn't necessarily scaling back the performance, i.e. the internal China silicon? So, I think there's usefulness. I think definitely, as we've heard, from many others, AI inferencing is still early innings, and that proliferation is going to expand not just the deployment of AI chips, but also the workloads that become much more diverse. And so that's going to expand, I think, the usability of these chips over the longer term as well.
Just overall, though, I mean, even taking China out of the equation, Aaron, how comfortable are you right now with the amount of spend, the CapEx spend that we're seeing in the AI space, whether it's on the chips themselves or the data centers where a lot of those chips are going into?
Yeah, so I think, again, the inference side, we're still early. I think we're starting to hear more about enterprises doing $20 million, $50 million kind of projects on AI efforts to bring inference into their applications and environments. And so I think that's another tail, a longer tail of this AI, kind of a path that we're going down. When you look at that hyperscale CapEx, I was just looking at some numbers. I mean, coming out of this last quarter, we had yet another significant raise in forward CapEx expectations. Looking at calendar 26, we saw the top four CapEx expectations for the big hyperscalers move up by another 20+%, and it looks like it's going to grow another 20% into next year. So we see strong durability of demand into 26. We'll continue to debate how 27 and beyond still looks.
All right, Aaron, great stuff. Aaron Rakers there, Technology and Services Senior Equity Analyst over at Wells Fargo. A closer look at the chip space, a closer look at tariffs, and a closer look at trade. We dive deeper into that when we come back after the break with Mary Ng, the former Canadian Minister on International Trade. This is Bloomberg. 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Vonnie Quinn. US-Canada relations in focus now. Joining us to discuss, Mary Ng, former Canadian Minister of International Trade. Mary, Canada is, facing difficulties on multiple fronts. Obviously, China in the news today, but, you've had a 25% tariff on non-USMCA goods for several months at this point, and the economy is suffering. What advice would you give to Mark Carney right now?
Well, the Prime Minister is at the negotiating table, and he and his team will continue to do that. And I think my advice would echo that of Canadians. It's really important that Canada gets a good deal and not just any deal. And I think Canada has a lot of advantages that we should feel strong about. Part of that as well is how is it that we can continue to do the work here in Canada by being stronger, by being more competitive, by being more productive. All the things that the Prime Minister is currently doing, and at the same time doing the work that's necessary to safeguard access to this important market, which, by the way, is not only good for Canada, it's actually also good for the United States as well.
You're also waiting for a decision about lumber. Is it very, pivotal what way that decision comes down? I mean, obviously, in a sense it is, but there's also the possibility of giving subsidies to lumber producers, for example, but that's going to inflame tensions even more. So it's a real catch-22 situation, isn't it, Mary?
Well, softwood lumber is a really important industry here in Canada because the forestry sector is so important to Canada. But I would also say to the Americans, as I have in the past and continue to do so, I know that you want to build homes, and I know that you want homes that are affordable. And when you make Canadian lumber more expensive into the United States, it just really makes building homes more expensive. Those are the conversations I've had, certainly with your home building associations in the past when I've gone down to America, and they would agree. So the question really is, how do we find a path forward so that this supply continues to go into America?
Yeah.
And that there's a win-win essentially, but it's not tenable to have 35+% tariffs on an industry like this. It's not tenable to have 50% tariffs on on an important sector like steel or aluminum or copper, because the inputs that go into the United States ultimately are then borne and paid for by American businesses, manufacturers, right, importers.
Well, this is what I'm curious about. Obviously, we have steel, you have autos, you have lumber. There are a lot of commodities, and there's a lot of cross-border trade in that. Not just one finished good going back and forth, but you have a lot of raw materials that go into one country, get refined in some way, go back to the other, and then come back. That's like almost 70% of your trade right now is with the United States, or at least it was coming into this year, Mary. And I am curious as to what options you discussed before you left the administration there under Trudeau. What options were discussed, and maybe what options are being discussed under Carney to supplement whatever might be lost with the U.S.?
Well, I just want to pick up that point you just made about the integration, the nature of the integration of the market between Canada and the United States. And the Canada-U.S.-Mexico agreement, which you call USMCA there, we call it CUSMA here. The good thing at the moment is that there is still CUSMA compliant or USA compliant that really is about, according to the Bank of Canada just a few days ago, covers over 90% of Canada's exports to the United States. And those and really what does that mean? It just means that 75% of the content that needs to be created. And you're seeing that in sectors like whether it's energy or whether it is auto manufacturing. If we're able to keep to that CUSMA compliant, then there really is no tariffs. And I think that is really good for Canada, and I think that our administration, our government, needs to keep working with the Americans to ensure that there's a win-win there, and we are seeing that because I know that the American companies, because the supply chains are so integrated, do not want to see a higher cost borne on those inputs that go in and that cross the border, as you rightly pointed out, several times before a finished good is made.
But when we talk about what the relationship is going to look like, and I don't necessarily mean just Canada, U.S., but really Canada's relationship with the world. I know that at least under Carney, and I think it kind of started under Trudeau, there was some attempt at a reset with India and the relationship there to improve trade ties. I know there's been further outreach by Carney to other Asian nations. And I am curious as to, do you think we're entering sort of a world where sort of one sort of big global trade environment is just no more? That this is going to be about regional blocks, and in some cases, certainly on the U.S. side, more one-on-one bilateral type of trade deals and agreements?
Well, the Americans have certainly decided to change the architecture and the way in which they're trading and the various relationships that they're having around the world. I, as Canada's trade minister, I've been the longest serving trade minister in my country. I've never not had trade diversification in my mandate from the Prime Minister. Canada has access to 65% of the world's economy through a network of free trade agreements right now. And we are doing a number of things right now in response to what the United States have put forward. And that is, let's reduce some of that reliance, because I think in investment terms, you don't want to have all your eggs in one basket. You want to make sure that your portfolio is diversified. We have great partners through the CPTPP, so that's the the old TPP, the Trans-Pacific Partnership, with countries like Japan and Australia and Singapore and Vietnam and all the rest, but also with Europe and a whole range of networks. So I do think that there is an opportunity to diversify and continue to create an economy that can work not only for Canada, but for many of our global partners around the world. And I think that is the work for sure that's taking place right now.
In the short term, though, it's going to hurt, Mary, before all of those relationships can be up and running, right? So from Thursday, for example, China is putting on more than 75% tariffs on rapeseed. Now, farmers are about to harvest what's going to be canola, right? What do they do with all of that if they can't sell it to China and other places?
We're gonna have to look for new markets. I mean, getting tariffs on Canadian products that are not responsive to what we have always respected, which is an international rules-based system, is just not good. So we are going to have to look at other markets. We're going to have to look at how we are stronger within Canada. There's a great piece of work that's being done by all the provinces and territories here in Canada around removing trade barriers. I would say to the world, look, I mean, Canada is a good place to invest. It's a good place to invest with a strong foundation of a rules-based society with great people and talent. And the kind of work that the Prime Minister now is doing is building big projects in this country, right? I mean, critical minerals, to which we have, we have an abundance of those minerals that can be mined sustainably in our north. We have infrastructure projects that can come online. We are a huge energy supplier and an energy mix that includes LNG, that includes a range of mixes as in this country. So yes, you're totally right. It is going to be hard in the short term, even in the medium term. Yeah. But I think that this is the hard work that we're going to need to do. And I don't think Canada's alone in this, quite candidly.
You are certainly not alone in that. Of course, every nation right now trying to find the best tack to take going forward with, if I can say it myself, with the country here in the United States. It's, well, been a little difficult as of late. Mary, appreciate having you on the program. Mary Ng there is the former Minister of International Trade for Canada. When we come back, we're going to take a look at U.S. markets and take a look at one of the biggest movers out there, Hanes brand, on a tear as reports surface of a potential buyout. It's our stock of the hour. It's up next on The Close on Bloomberg. Time now for our stock of the hour, and we're taking a closer look at Hanes brand, a 28% rally in the shares here on the day after Bloomberg reported that the company is exploring a deal with the Canadian activewear maker Gildan. Gildan is said to be considering a cash and stock offer valuing the underwear brand at about $4.5 billion, including debt. Abigail Gilmartin covers the U.S. retail sector for us at Bloomberg Intelligence, specifically athleisure footwear. And she joins us right now to talk a little bit more about this, a surprise of a deal. It also seems like there's some overlap, or maybe not.
Yeah, definitely. Yeah. It'll be bringing together two of the biggest basic apparel manufacturers globally. So the overlap really is the basics, the T-shirts that Gildan has a big share in, and then the innerwear, which Hanes brands, as we know, does pretty well in.
Both of them, some of that is interchangeable.
Yes, and then some of that is interchangeable, and both of them have tried to kind of do that. So together, I think it'll be bringing them together and really allowing them to leverage their sourcing and manufacturing abilities to drive scale.
Why now? Has it something to do with the price? I mean, obviously, we're seeing a huge rally today for Hanes brands, up 27% at this point, but $5 billion?
Yeah, so I think that this has been considered for a while under Glenn Chimandi of the Gildan brand, but there was some shareholder issues with that, which happened last year. So I think at this point now they're both facing tariffs and macro headwinds, and combining them together will allow them to leverage their scale and kind of drive more margin upside at a time when their costs are under pressure.
But when you say margin upside, you're saying pricing power in terms of what they're passing on to the consumer, or is this going to be a merger that allows them to actually decrease their costs or at least keep them contained?
That's a great question. So one is pricing power, definitely merging together with wholesaler distributors especially. They'll have greater pricing power, especially in an area where price is very key to the basics market. Yeah. Additionally,
because nobody wants to pay like $1 gazillion for it. It's like when you go to a concert and charge you $60 for a t-shirt.
Exactly.
Which Gildan's is just Gildan with something silk screened on.
Yeah, Gildan's selling their $3 t-shirt for someone else to take it and then make it more and then sell it. Yeah. So I think it makes a lot of sense for that.
What about the activewear? So obviously Hanes brands already decided to get rid of Champion or divest it. Yeah. Will Gildan, miss out on that, or is this all part of a larger plan?
No, this is all more of a larger plan. I think it's going to allow Gildan to kind of break into Hanes brands has a higher gross margin. They have higher, more branded products per se, whereas Gildan is just the commoditized thing. So that's going to give them higher margins, but it's also going to give them greater relationships with wholesale distributors that Hanes brand has already.
Any issues that we should be looking for with regards to regulation? Is this a deal that's just going to fly through, or should we be concerned about a potential antitrust pushback, which I know is kind of a ridiculous question with this administration, but I have to ask.
Yes.
Yeah.
Well, so, I mean, I think there'll definitely be some review, making sure the market shares are, because it's very consolidated market shares, but we've seen this in the past with other apparel companies that have been able to merge, like PVH and other ones, so.
Yeah.
Yeah, it's fascinating. I mean, we sort of know Gildan as, you know, American Apparel and some of those other brands, right? That's how we would know Gildan best. Mind you, I haven't seen an American Apparel store in a long time. Thank you so much.
Exist.
They do not exist anymore, exactly. Yeah. Abigail Gilmartin of Bloomberg Intelligence. Romain, I don't see you in a $3 t-shirt ever, although I'm sure you'd wear it well.
I do, actually. You know what
Yeah.
I learned years ago?
Yeah.
And Abigail kind of pointed out, you can buy, did you know you can buy directly from them?
I did not know that.
Now
Well,
you have to buy a lot. You have to buy like 10 t-shirts, but it's like I said, it's literally like $3 or $4 a shirt compared to if you went into a retail store and they put a logo on it, you're going to pay $20.
I always hated those.
$30
I thought quiet luxury
there
was
you go.
like the
That's
the
your
end
life
of the
hack,
logo
Bonnie
anyway.
Quinn. There's the tease. We're counting you down to the closing bell with life hacks. Andrew Slimmon going to be joining us, Bonnie. Senior Portfolio Manager at Morgan Stanley Investment Management, as we count you down to the close with stocks up about 1% or 2% across the board, record highs. This is Bloomberg.
But from a market perspective, what I think they're seeing is that, look, there's no real concerns about the state of the economy. Yes, there's a slowdown, but in terms of recession risk, it's fairly low. And yet you're going to get preemptive Fed cuts, and that really creates a constructive backdrop for risk assets.
Seema Shah over at Principal Asset Management, kicking us off to the close just about 50 minutes ago. A close. It looks like, Bonnie, is going to be a record high with the S&P 64.42.
It really is quite incredible, isn't it, Romain? I mean, I know the market was waiting for that CPI data, and perhaps some of this is a bit of a breath of relief, if you like. But to see that Russell 2000 up 2.9% right now, those small caps really rallying, small business optimism. There was a lot to like about July, I have to say, including tariff revenue, and it really is fascinating. Look at that two-year yield as well after that inflation data, which may have been thought of as more benign, although there were sort of dark patches in there. But the two-year yield at 3.73 now, as markets really fully price in a September rate cut. And many people are saying, you know, 4 rate cuts by year end at this point. And then we also have gold settling down nicely. It is close to its record, of course, but it came off those highs.
Andrew Slimmon joins us right now, Senior Portfolio Manager at Morgan Stanley Investment Management. And Andrew, when you look at the complexion of this rally, at least for today, record highs for the S&P and a huge differential when you take a look at the economically sensitive sectors in this market, at least as measured by the Russell or the S&P mid-caps or transports. Biggest outperformance we've seen in months. Are you buying into it, Andrew?
Well, you know you have a powerful example of Fed is cutting, or Fed is expected to be cutting for a good reason, right? Which is inflation is tame, not a recession fear, and you're coming out of a better than expected earnings season. So good earnings, Fed cut. That sounds like a bull market to me. You know, what the question is, what is the dangers? And what amazes me, Romain, is that sentiment is not higher. And I have a feeling we're going to suck all that sentiment more bullish and before we'll ultimately get some surprise out there that I think could come, you know, in September. But for now, I think it's clear sailing. And the other thing that's going on here is the number one buyer of stock. Who's the number one buyer of stocks? It's corporations. And the window is reopening, and they will be aggressive buyers of their stock, you know, the rest of this month.
Well, that's what I'm curious about. I mean, so far, when you look at the rally off of those April lows, there's been a lot of hay made over the idea that so much of that was driven by retail investors, with a lot of institutions, at least the big funds, still, if not on the sidelines, certainly not participating eagerly. If you do see that window for corporate America open up and you see more of those buybacks or making good on those buyback pledges, and you get some of those institutions coming off the sidelines, what do you model as the potential upside from those folks, I guess, re-entering the market, for lack of a better phrase?
Well, I think it's tricky because the other thing that's going on here is that Q1 and Q2 earnings beat consensus. So if all else was equal, Wall Street should have raised their full year numbers by the magnitude of those beats. But because companies withdrew their guidance in April, they didn't guide Wall Street to a number anymore. Wall Street actually cut. So even though 2 quarters a beat, the full year number is lower today than it was at the beginning of the year. So Wall Street has a problem on its hand. The numbers are too low relative to what's actually happened. Now, if Q3 and Q4 turn out to be really bad, they'll be right. If not, they are going to have to play catch up. And I suspect after Labor Day, you're going to hear a lot of numbers being raised for full year. So when people say the market is expensive, they're looking at a P, the market, but they're dividing by someone's outlook of earnings. And I think that number is going to turn out currently to be too low, simply because the economy has been stronger so far than what Wall Street consensus expected. It reminds me of 2020 COVID. That's exactly what happened in COVID. Yeah. Companies withdrew guidance, Wall Street slashed earnings, and then they played catch up the whole rest of the year.
So these violent sell-offs that we've seen, Andrew, at times of fragility, are we not to expect those? Or if we do see another one, are you saying that we'll bounce back very fast?
Well, I mean, look, the problem, Bonnie, is that every pullback is an opportunity to buy, and I think we'll get that again. But I think my point of getting more and more people invested is as we get more people invested, what is the risk to the market? I think if I have to list the biggest risk is that maybe the August payroll number wasn't just an aberration, and if we get another weak September number, then is the Fed cut in September not a kind of victory cut that inflation is tame, more of a economy slowing cut, and I think the market would be more nervous about that.
Andrew, you like home retailers and home suppliers. Is that purely based on the fact that you're anticipating Fed rate cuts? And what if we don't get them?
Yeah, I think that's the risk. But I'm telling you, these stocks will move before you see improvement in fundamentals. And so you have to, the number of times I've seen where home builders, they report great numbers and they go down because the market's already passed their good fundamentals. I think there's a very good chance the Fed will be cutting in September. The market is telling you that. These stocks started to rally about a month ago. I think you got to get in before. You can't wait around for the Fed. But certainly if the Fed did not cut, that is a risk. I think the bigger risk is that the economy actually payrolls. And I think, we're not talking about AI, and I think that's putting on hold a lot of hiring at companies for entry-level jobs. I think the real risk here is that the payroll number might come in weak again in September.
All right, Andrew, got to leave it there. Andrew Slimmon, Senior Portfolio Manager at Morgan Stanley Investment Management, helping us count you down to the closing bells here on this Tuesday afternoon, Bonnie, with the S&P near a record high, more than 400 stocks in that index higher. But I think it's kind of interesting, too, to look at the types of stocks. It's a lot of sort of those economically exposed cyclical names. The two biggest gainers are airlines, United and Delta. Then you have semiconductors. You have a lot of apparel makers. You have other travel stocks. You even got Paramount, Skydance, of all things, up there at the top of the leaderboard.
I noticed that. But what's good for the airlines, for example, is going to be bad for the consumer eventually. So while the stocks might be getting awarded today, that 4% increase in airfare is not going to do anything for the pocketbooks. Not much movement in yields on the day. You did see the shorter end of the curve, your 2-year yield, down about 4 basis points, but the longer end of the curve continues to rise. And I think that's a big issue here because we talk about this idea of a market betting on rate cuts. You see that reflected on the short end of the curve. The long end of the curve, those rates going up, that seems to be a vote that maybe there could be some economic weakness up ahead. Yeah, exactly. I don't think... or fiscal weakness as well. As we count it down to the closing bells, we're going to break down all of today's market action and set you up for the next day. That conversation starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic here with Bonnie Quinn, taking you through to that closing bell with a global simulcast. It started. Carol Master in the radio booth. David Gura in today for Tim Stenovic. Welcome to our audiences across all of our Bloomberg platforms, including our partnership with YouTube, on a day where we see the S&P up 1% at a record high. The Russell 2000 up 3% on the day, Carol Master. And that's all because CPI rose?
Well, the expectation is what now? Yes, indeed. Check. We're going to get that rate cut come September. But as our Mike McKee and others remind us, we have a bunch of data before we get to that next Fed meeting. So hold on, everybody.
Bunch of data, and of course, the meeting in Jackson Hole as well.
Michael, I'm ready to party.
He's ready to party. Data aside, he's ready to party. But yeah, a lot of data. We're going to get these policy speeches as well. So a lot to happen here before the Fed meet once again, Carol, in September.
Not to pick on Carol, but why is everybody poo-pooing this report? Because everyone keeps saying, oh, just wait till we get to the next PCE thing, or wait till we get to this a month from now.
Do you really think the tariffs are all baked in yet? We have some major trading partners that we have yet to figure it out.
I don't know, but I guess, does it matter? I mean, if you're an equity investor, at least, you enjoy the ride until it's over.
If inflation starts to pick up again and the Fed cuts and then they have to raise rates again, I don't think that's great policy.
Yeah. Bonnie, what do you think?
Well, exactly.
Are you on my side or Carol's?
I also think it's a little freaky that it was
Answer carefully, Bonnie.
I'm on both of your sides. And also
That's
David's side. There's three sides.
No, there's no side.
Here.
David has no
but
side.
But basically, I think it was a little freaky that it was services inflation that went up so much as well,
All right, let's break down the numbers here because we do have a record day on Wall Street, but more importantly, one that I think defies a lot of expectations. The CPI report that did show inflation is still there and on a year-over-year basis still holding at levels that it's been, but a lot of now optimism about the idea that at least with it being somewhat benign, the Fed will have the room to begin those rate cuts as soon as it's meeting in mid-September. The S&P 500 ending the day higher by more than 70 points, 6,445 and change, up about 1% on the day. The Dow Jones Industrial Average making a similar move on a percentage basis. The NASDAQ Composite up about 1.4% on the day, similar move for the NASDAQ 100. But look at the cyclical sectors. S&P Midcaps up 2.3%. Dow Transports up 3% on the day. The Russell 2000 also up 3% on the day. Carol Masser, maybe potentially a vote of confidence that maybe it's safe to embrace some of those cyclical and economic names.
You almost sound irrationally exuberant, but I'm going to be very careful here.
Well, don't worry. I'll be pessimistic tomorrow.
S&P 500, folks. Most names, broad-based buying, as Romain just laid out, 401 names to the upside in the S&P 500, 100 to the downside, Vonnie, and 2 unchanged.
You heard that incredible roar from the exchanges, right? Guys, it's incredible, the performance today. All sectors in the S&P 500 ended in the green, even consumer staples, which was lagging just that tiny little bit. One tiny sliver of red, and that was insurance companies, but even then they were down literally fractionally.
All right, guys, let's get to some of the individual gainers. Got to mention airline names in today's session, up about 9% as a group overall. We did get a read on inflation. We saw airline fares, a big contributor to the Supercore services gain, that 4% monthly increase, the biggest for this category in more than 3 years. We also talked a little bit about Spirit Airlines and what's going on with them, and then maybe that provides more business for others as they have their own struggles. So anyway, airlines definitely some outperformance. United, in fact, that stock alone was up 10% in today's session, the number one gainer in the S&P. Delta was the number 2 gainer. Want to mention the SOX, the Philly Semiconductor Index, that was up about 3% in today's session. Shareholders reacting to CEO Lip-Bhutan's meeting with President Trump. The president describing the meeting as a very interesting one. He talked about his amazing story, his background, a little bit more positive. So Intel also up about 5.6% in today's session. And then AST Space Mobile, we talked about it a little bit on air, David and I did with Nora Melinda. It's a satellite firm. It's set at an ambitious plan to launch about 45 to 60 satellites this year and next year. It also said it received 2 additional early stage contracts from the U.S. government. So that one, some outperformance there as well, David, up 8%.
I'm looking at decliners. Nobody wants to hear about decliners on a record-setting day, so I'll move swiftly through these. But I am looking at a couple of healthcare services stocks on this Tuesday, a broad umbrella, so much underneath there. But McKesson's the first one I'm going to point out here, headquartered in Irving, Texas. It announced plans to spin off its medical surgical solutions business segment into another discrete company. Another healthcare services company I'm looking at is Cardinal Health, down about 8% today, buying Solaris in a $1.9 billion deal. That on the heels of a miss in adjusted operating income. I think it's down the most since 2021. Last company I'll flag here is Aon, that professional services company. A lot of action in the option space there, but we're seeing it down today as well, guys.
And we take a quick check on yields, and I think the steepening of the yield curve really tells the story of where this market's head is at. You did see short-term yields drop, the 2-year down about 4 basis points, as now the market seems to price in a much firmer possibility that we will get a rate cut in September, and that includes a 94% chance, based on Bloomberg calculations, that we will get a 25 basis point cut at the September meeting, and an 81% chance that we'll get a second cut before the end of the year, basically what's already been telegraphed on the dot plot. And of course, all of this has to do with the idea, the read-through, Carol, that we're getting right now, potentially from that CPI report, that the impact of tariffs may be a little bit less severe than what the market had priced, or at least the president wants to make clear that, well, that's what he thinks. And he had some choice words for none other than one of the big bank CEOs.
Yes, indeed. We're talking about Goldman Sachs. President Trump saying that the Goldman Sachs team and the CEO, we're talking about David Solomon, he criticized it, saying the bank was, quote, wrong about the tariffs and their impact on consumer prices. So a research note that was out by Goldman said the impact of those tariffs from the president on consumer prices was just starting to be felt.
And we should point out that research note was not put out by David Solomon. It was put out by Jan Hatzius.
Hobbyist researcher at Goldman Sachs.
Just want to make that clear. So, all right.
Not that he couldn't if he wanted to.
I'm sure if David Solomon wanted to, I think he has other things he has to do during the day.
You're tough today.
But part and parcel, I think, of this theme we're seeing from the president weighing in on all manner of corporate affairs. So Carol, just a moment ago, talking about Intel, we heard the president calling for the resignation of that CEO a few days ago. Here he is going after Jan Hatzius, not by name, David Solomon as well, taking a, shall we say, more muscular role here than previous presidents have in kind of advising large American companies on the way they should conduct.
Yeah, I mean, he does
business.
like not getting credit, does he, David? He literally said David Solomon and Goldman Sachs refused to give credit where credit is due, and he, tweeted that out well before he said that David should go and get himself a new economist, or maybe he ought to just focus on being a DJ and not bother running a major financial institution. He's just the next CEO in the crosshairs, right? I mean, will we be seeing him visit the White House, David Solomon, like it was Le Boutin just the other day?
It gets to the idea, though, too. I mean, we talk about a market at record highs, at least for the S&P and the NASDAQ, and the Russell looks like it's trying to claw its way back towards it. But your point, David, about this, the interjection, if you will, by the president and the White House into so many things that, at least in the past, it would have just been left to its own devices. Let corporate America do its thing, as long as, of course, they're not breaking the law or doing anything unethical. But now with his sort of finger on the scale, whether it's with Intel or the latest comments about Goldman Sachs and David Solomon, does that become a potential market risk, a potential headwind going forward?
For sure, a question. Let's just bring you Rigetti earnings really quickly, because of course this is the quantum computing company that really had the market's attention there when it did a demonstration just about 3 or 4 weeks ago, and the stock price shot up and we had a bunch of price targets come out after that. The operating loss wasn't as bad as anticipated, $19.9 million. The estimated operating loss was for $20.9 million. And then second quarter revenue, $1.8 million. The estimate was $1.87 million. So slightly shy on revenue, but again, a better operating loss than anticipated. That stock has been rising in recent sessions.
Can I just say, Romaine, I think you're right. And I think David's right. Like this idea that CEOs have to be...
We'll take it, both of us. Yeah.
No, but I think they have to be so careful, right? It's almost like nobody wants to be caught on the president's social feed. And because you don't know, we do see stocks move on it. We certainly see, we end up doing segments on it because there is concerns about what that might mean in terms of regulatory or oversight. I don't know, but it definitely is tricky for, I think, companies and CEOs.
Yeah, and we should point out, we've been talking to a lot of folks today about this CPI report, and they also point to this idea of the resiliency right now of corporate America, the idea that the bottom lines for a lot of these companies are holding up, and we continue to get our earnings crossing the wire. We have H&R Block, of course, this is the tax prep company. Those shares actually moving lower in the after hours trade. The company in its fiscal fourth quarter did report a slight beat in revenue of about $1.11 billion. But on the EBITDA basis, basically the bottom line here, the company says that it's looking at about $413 million, and that's slightly below what the street was looking for. The company did increase its quarterly dividend and did provide a fiscal 2026 forecast for revenue of $3.88 billion to $3.9 billion. The street was looking for a 3.83. Who's next?
I don't know. We're waiting for CoreWeave. It's just... CoreWeave is actually crossing, so let me just start with that if I can, guys. Second quarter revenue, we're just getting one number so far, $1.21 billion. The street estimate is $1.08 billion, and we're seeing CoreWeave already a pop about 2.8% here in the after hours. Second quarter loss of 60 cents a share. The estimate on the street was for a loss of 46 cents, so that seems a little bit larger there. And second quarter adjusted EBITDA margin remained 62%, slightly better than the street estimate of 61.9, pairing some of the gains, but still up about 2.2% here in the aftermarket. Something that we've been watching certainly for the results of this company.
Also keeping an eye on Lumentum. It kind of makes lasers and optics. They kind of use in data centers and in the AI space. Those shares moving higher in the after hours trade after reporting a beat on the bottom line for the most recent quarter, 88 cents a share. The street was looking for 80 even. Net revenue also coming in above estimates at roughly about $481 million.
All right, guys. Yep. Thank you so much. That is a wrap.
Thank you too, Carol. and thank you, David.
Thank you, Romaine. I appreciate it.
Yeah,
well done.
absolutely.
Well done.
I'm always on your side. So.
Wait, what?
Wow.
Out of here. Out of here. Out of here.
We get more David Gura on here.
He's such a nice guy, and then he says something like that. All right, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals, Romaine and Bonnie continuing there on television. David and I continuing right here on Bloomberg Business Week Daily. We'll see you again, same time, same place tomorrow.
When we come back, our coverage continues here on Bloomberg Television with a deeper dive into some of those earnings, including CoreWeave. Stick with us. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Bonnie Quinn.
And I'm Romaine Bostick. A record day on Wall Street with the S&P and NASDAQ 100 closing out at record highs on the day, a 1% move for the S&P. The biggest laggards there were actually in some of those defensive sectors like staples, real estate, and utilities. It was tech, it was financials, materials, and a lot of discretionary stocks that helped to lead the charge higher for the broader indexes. In fact, that was really reflected. You don't see it on your screen there, but trust me, the Russell 2000 up 3% on the day, the biggest outperformance that we've seen in the small cap index relative to the big cap index, the biggest outperformance going back to November of last year.
Romaine, Cava plunging in the post-market. Revenue outlooks, comp sales, all missed estimates. Now, it did beat an adjusted earnings per share, came in with 16 cents in the second quarter versus the estimate for 13 cents, but really everything else missed and missed big. So second quarter comp sales were up 2.1% when the estimate was for 6.1%. The full year restaurant comp sales, it's brought back its forecast for that. It now sees 4 to 6% growth. It had seen 6 to 8% growth. And revenue overall in the second quarter came in below estimates as well at $280.6 million versus $285.6. So really, for the fast casual restaurants, it has not been a good quarter.
Yeah, a lot of concerns there, and actually some concerns right now going on in the cloud infrastructure space. CoreWeave just reported earnings. Those shares down about 6% in the after hours trade after the company said that in the fiscal second quarter, it did see its revenue actually beat estimates, but it did post a loss per share that was wider than what the street was looking for, 60 cents a share. The street was looking for 46 cents. Anurag Rana covers this company for us as an analyst over at Bloomberg Intelligence. And Anurag, I am curious here. I mean, I look at the numbers here. They're not awful, but I am curious as to what your initial takeaway was from the numbers and why we're seeing a negative reaction in the stock.
Yeah, I'm surprised about the negative reaction because the results are pretty good. The backlog is good, and CapEx was not as high as they had communicated in their guidance. So I'm a bit surprised, but the big thing for this company at this point is what kind of guidance do they give when they are on the conference call, because that's what they will explain whether CapEx is going to ramp up in the second half or not. Because what we have seen is that the demand is extremely strong right now, and unlike Microsoft or Amazon or Google, they don't have another business that's a cash cow business that can fund a lot of these high capital expenditures that are so that will eventually happen in the company to take care of all the backlog.
Anurag, is it possible, though, that this is just, a little bit of profit taking in some senses, because there had been a huge run up, and even recently it was down about $100 a share, back up to 140. I mean, these stocks move.
Yeah, there is a lot of volatility in the stock. And remember, the IPO came out at $40. So this is not there is a huge delta between going out at 40 to the current price. But at the same time, I mean, this stock will move quite a bit because I mean, it requires a lot of funding in order to take care of the backlog. I mean, we just heard that the backlog is up to 30 billion at this point. That's a very big number. Last quarter was 25. So, sequentially 5 billion in just quarter is a very big shift. So things are good, I think, from a fundamental basis. But the big question is, how much cash do they have to raise going forward in order to take care of this demand?
This gets to this idea, though, too, and I know we've asked you this before, about the amount of spend that we've seen in this space and the idea of whether it is maybe too much or not necessarily, maybe let me rephrase it, not necessarily too much, but whether it's being spent wisely, Anurag.
So one of the big things at this point is, when you look at the top 5 vendors, and I would put CoreWeave in it at this point, the top 4 of them have extremely profitable businesses on the side. So whether it's Amazon Web Services, whether it is, essentially even Oracle, I mean, it has a huge software business that can help them fund the spike in CapEx. For CoreWeave, I think a lot of questions come into is, what's their balance sheet look like, whether they have to increase their funding requirements. And also, there is this overhang of the lockup expiring. So there's a lot going over, right now as the stock is related. But from a fundamental point of view, I mean, things are pretty good for them at this point.
Yeah, for sure. We could see some of those filings on Friday, so we'll be keeping our eye out. Anurag, thank you so much. That's Anurag Rana of Bloomberg Intelligence, who covers technology. Helping us continue break down CoreWeave results now is Gil Luria, Head of Technology Research at D.A. Davidson. Gil, do you agree with the characterization there that all in all, it really wasn't that bad of a quarter for CoreWeave?
Sure about that. I would say that the most important number to look at is the fact that they generated $200 million of adjusted operating income and paid $266 million of interest expense. That is the main issue with CoreWeave, is that really all of their cash flows and then some go to the debt holders. The equity holders actually don't get anything right now, even though this company is at a scale to reach $5 billion of revenue. Really, there's no cash flow left for equity holders. The other points that Anurag was made, which were very important, is that the company last quarter guided at $23 billion of capex. Now that means that for the year they will need to raise around $25 billion, at least $25 billion of capital. In the first half of the year, they've raised $3 billion. So they need to raise a lot more capital. Much of it is going to come from debt. They will need to announce at least some of that on this conference call to make sure that they have the capital available to live up to the commitments that they made. Otherwise, they won't be able to continue to scale the business. But back to the original point, I'm not sure that this is a business worth scaling if they can't generate more income than they're paying in interest.
Well, that's what I'm curious about. I mean, their debt levels, I mean, at least on a bottom line net debt basis, I mean, already up something like 8-9-fold just from a year ago, or I should say back in 2023 to the end of 2024. When you look at their cash needs going forward, Gil, what types of interest rates do you think they'll have to pay? And two, with regards to servicing that debt, is it even viable given what they already have on their books right now?
So their interest rate has gone down from 12.5% last quarter. They're now raising capital at debt at more around 9%. That's still well below investment grade. Very expensive capital. Again, this is a company that competes on capacity with the hyperscalers, whose cost of capital is probably closer to 5 or 6%, and their cost of debt is 9%. Their overall cost of capital is even higher than that. So for them to live up to the obligation this year, they still need to raise $25 billion of capital. If that's all dead, they're already making what's a very bad balance sheet even worse. If they can't raise at least a big portion of that $5 or $10 billion in equity, then they're really creating a situation where at best they'll be able to pay down the debt they have. At worst, even that's not all viable.
And Gil, the lockup expires later this week, so could the story get even worse, even more difficult for the company if investors do start to head for the exits?
Well, that's what we'll have to be monitoring, is did the company have an orderly way to help the shareholders sell their shares in a secondary transaction and then possibly raise some primary capital that's really the only viable way forward for the company is to raise equity capital. They'll need to do it in conjunction with a secondary offering where the existing shareholders sell. One way or another, it's going to add a lot of volatility to the shares.
Yeah, all right. Well, that's going to make the conference call a lot more interesting. And of course, investors are really, equity investors, going to have to really be on pins and needles over the next few days and weeks, whether that capital raise comes through. Luria, head of technology research over at DA Davidson. And we should point out those shares continue to weaken, now down roughly about 8% here in the after hours trade. Unfortunately, that's not as bad as Cava. Those shares down more than 20% right now. We're going to break down what exactly happened in the fast casual restaurant chain's most recent earnings report. That's coming up next here on The Close. This is Bloomberg. Taking a look at shares of Cava, down more than 20% in the after hours trade. The fast casual food chain just reporting earnings showing that comp sales in the most recent quarter coming in higher by 2.1%, but that was about well below what the street was looking for. They were looking for growth of about 6%. The company also guiding for the full year of comp sales of 4 to 6%, which is below their previous estimates. Daniela Sirtori joins us right now, who covers the restaurant chains for us. And what's going on with this company? Are just fewer people coming into the store? Is it the same number of people coming into the store, but they're spending less? What?
It's an interesting combination of factors for Cava. So their traffic was actually flat for the quarter, which is better than what other restaurant chains have posted, but it is rare for Cava. Cava has been a high growth company. I mean, I was checking the numbers recently, and like last quarter, the same quarter a year ago, their comp sales grew 14%, in that second quarter. So, there is that idea that expectations are pretty high for this company. At the same time, we're operating in a difficult consumer environment, and people are getting a little bit skittish about where they're spending their money. I was chatting with the CEO earlier, and he did say that trends, decelerated into, in June before kind of recovering a little bit as the quarter wrapped.
Which is interesting because we already saw that with Sweet Green and Chipotle, but Cava is actually priced a little lower than those other two, right? So, even at the lower price point, consumers seem to be pulling back a little bit. What did the CEO tell you about tariffs and the impact? Because they had said earlier in the year they weren't going to try to source, elsewhere, things that they were getting in places like France and Greece.
The type of stuff that he talks about when it comes to tariffs is more about the effect on the consumer and the fact that things have changed so much that, people are sort of uncertain about the environment. And so what he told me was that, certainly compared to a year ago, the environment is just not as good. There aren't as many tailwinds, for a company like Cava. They're still trying to keep a lid on prices. So, the CEO told me earlier today that, they did increase prices by 1.7% in January, but there's not more coming. And it does seem that they recognize that the consumer is under a lot of pressure.
There's been a lot of talk, and we've had the Cava CEO on. We've talked a lot about their expansion. We've also talked a lot about their geographic strategy, the idea that, at least at the start, they were very much more weighted towards suburban areas rather than sort of dense urban areas. Do you think we're going to see an update on that strategy? I don't know if it's going to happen on the conference call tonight, but maybe over the next few months. Is that possible?
It seems like they still are. The breakdown that the CEO gave me today was about 85% suburban, interestingly enough, and it seems like that's going to continue to be the idea. It seems to be working out for them. They do say that the new openings are doing well. Of course, that kind of plays against them when it's a year later and then they have to comp. They have to, go up against those good openings. But, they actually took up a little bit the number of stores that they're going to open this year by about 2 on the high end. So it seems like even though we're going through like a tough environment, they still think that they have, they're right on the confidence to open new locations.
Daniela, thank you so much. That is Bloomberg's Daniela Sirtori, and that company losing a quarter of its market capitalization right now in the after hours, at least. I mean, liquidity, of course.
And you think about the last week when we got Sweet Green, those shares plunged 20% as well. And I know Daniela said that it's a little bit of a difference there, but it gets to this idea that they are priced somewhat aggressively. I know it's not as expensive as going to like a fine dining restaurant, but when you talk about paying $15 to $20 for a lunch or for a single dinner or for a bowl of food, that's going to turn off a lot of people who maybe are struggling a little bit.
And Neil Dutta just making the point that this is back to office workers.
Yeah, and we should point out we are going to have the CEO of Cava here on The Close tomorrow, and we're going to get hopefully a little bit more insight out of him as to what the strategy is going forward, Fani.
And then next up, we're going to be talking rates with JPMorgan's head of global rates, Jay Barry. Do stay with us. This is Bloomberg. inflation accelerating at the fastest pace since January. Kansas City Fed President Jeffrey Schmidt says the central bank's policy stance is still appropriate for the time being. Jay Barry and the team at JPMorgan expecting the Fed to resume easing in September, with cuts at the 3 meetings following that. And joining us live in studio is Jay Barry, head of global rate strategy at JPMorgan. I'm going to start with the obvious one. Is the yield curve where it should be, if that's indeed what the market is expecting?
Yeah, Vani, thanks for having me. And if you look at it, short-term markets are basically fully priced for a 25 basis point cut in September, pricing in about 60 basis points of cuts for the remainder of the year. So a little bit less easing than our forecast for the balance of this year, but broadly in line with what we would expect for a September cut right there in the context of a labor market that's been weakening.
Was there nothing that made you uneasy about today's CPI report? Because I feel like the market really just took it in its stride and was like, oh, sure, services inflation, that's fine. Airfare's up, doesn't matter, it's going to be all good. But there's plenty to be worried about, I thought.
It absolutely did. I think the overall core number in line with what we would have expected, but I think there is some encouragement from the fact that you didn't see any pickup in core goods pricing so far, where it's another month with the tariffs in place where you haven't seen them pick up. That has given market participants a bit more sort of lack of concern right there. And you pivot it back to the labor market after today, that if we know the Fed has an asymmetric reaction function and seems to be more concerned about labor market weakness than inflation being above its target, and with the slowing we've seen in private payroll growth, it kind of gives the green light to go back and think about the Fed cutting in September, even with inflation very far away from the Fed's target.
Prior to this report, were you in the camp that we were going to get those 2 rate cuts this year that were put on the dot plot?
So we actually changed our forecast last week. It was in a little bit of a delay after the weak July employment data.
Yeah.
And normally I don't think we'd make a change based off of a single employment number. But when you add that in with the dissents that we saw in July, and the president has nominated CEA Chair Miran to the seat that has been vacated by Kugler, it tips the balance in that favor, particularly when we know they're more concerned about bigger labor market weakness than inflation remaining well above target right there.
This gets to an idea of a market that let me just phrase it this way. Do you think the market might be getting a little bit ahead of itself? When you look at the record highs on the S&P and the NASDAQ, the Russell up 3% today, yet we're talking about weakness in the labor market, and I'm not sure what a 25 basis point cut or even 50 basis point does to resolve that in the short term.
I think the aggregate amount of easing priced in absolutely remain, because you can see that labor demand has definitely slowed because of what we're seeing in private payroll growth. But initial claims are still pretty low. The VU ratio is back where it was in 2019. So labor markets are not as tight as they were, but they're not falling off a cliff. And you're right, financial conditions are actually a tailwind for growth. So we've got a period of weakness coming in the next couple of quarters, which makes the case that in order to sustain the expansion, the Fed can continue to ease. But does it need to get back to neutral? We don't think so, unless you see signs that the labor markets are really weakening from here.
How stretched is the consumer? We just had Cava earnings, and their outlook is not very pleasant for the diner. And we saw the same thing from Chipotle, we saw the same thing from Sweetgreen, and plenty of other consumer companies too.
We're looking for about 4.5% annualized core inflation the next couple of quarters, Vani, including this quarter, as the impact of tariffs hit the consumer. And that's going to take real consumption down to flat, if not negative. So it is a hit. But overall, with the labor market still close to full employment and about $50 trillion in household wealth accumulated over the last 5 years, we think consumers are still actually in okay shape. So while consumption is slowing, we don't think that consumers are about to completely retrench, given what we've seen on the financial condition side.
So is the steepener still the trade?
Absolutely. I think there's a case to be made that given the bigger risk to the economy, there's a bigger likelihood the economic outcome is much weaker than much stronger. So that would bias you towards much lower rates versus much higher rates. And if anything, it's really tough to hold on to being long at the front end of the curve because of the inversion of the money market curve. So the steepener is another way to play that kind of long on a lower beta basis, but also it helps you position for more elevated term premium, which the backdrop of the shift in demand for Treasury assets from price-insensitive investors to price-sensitive investors gets you there, and also the overarching continued criticism of the Fed, that probably keeps a premium in break-evens, which also keeps the curve steep.
I do want to get, if you can expand on that, because it's more than just criticism. I mean, the Trump was out once again talking about Jay Powell. Of course, you had whatever's happening over at the BLS, and of course this idea floated of maybe suspending the monthly reports temporarily. There's been a lot of concern about whether, I guess, the White House is maybe trying to put their fingers on the scale, and whether that's going to raise questions about the credibility of data, and more importantly about how accurate of an economic picture you're actually going to get over the next few months and quarters.
I think both the Fed and other institutions in D.C. have a lot of credibility built up over a longer period, Romaine. And given, particularly with the Fed, the collegiality it requires to actually create consensus on the committee, it's hard to dislodge it from its core mandate of stable inflation and low unemployment rates. So I think it's going to make it hard to have a behavioral shift. But the ongoing criticisms in a world in which the Fed does care about the expansion probably leans it in a more dovish fashion. So that probably kind of tilts it in that direction ever so slightly, because it's hard to really amend the Federal Reserve Act when you need the support of 60 senators to make a change there.
Yeah, absolutely. The other side of this, though, is also the fiscal equation. And I know we still haven't seen exactly what the tax bill is going to actually do for the economy, whether we're going to get all the benefits of that, and that'll be the tailwind, or whether we're going to start to really see a lot of the pressures from Treasury issuance and the need to sort of address the fiscal deficit, whether that becomes a headwind for markets.
Yeah, I think longer term, the jury's still out about what it does for growth. Our base case is that there's a little bit of fiscal expansion that occurs next year from the passage of the Big Beautiful Bill Act, because really this is just an extension of the existing tax cuts. So it's just going to mean that the fiscal deficit is going to head, we think, towards 7% of GDP. And in a world in which there's a big funding gap that the Treasury Department needs to address, at some point it's going to result in more long-term issuance next year. And that's another point that kind of keeps the curve relatively steep as well.
Jay, always great stuff. Jay Berry is the head of global rate strategy over at JPMorgan. A breakdown of that CPI report. Remember, we do get the PPI numbers, those wholesale figures, tomorrow. And later in the week, we get a really interesting read on the consumers with retail sales and, of course, the latest update of the University of Michigan consumer sentiment numbers. And we want to use that as a peg to turn to a business with firsthand perspective on the strength of the U.S. consumer. Milo's Tea Company. It's been in business for almost 80 years, and they're actually projecting more than $1 billion in retail sales by 2027. That's from selling tea. I'm pleased to say joining us right now is the CEO of Milo's, Tricia Wallwork, the granddaughter of the company's founders. Tricia, great to have you. And I kind of feel like you and your team at Milo's, you're kind of a unicorn. I mean, you're family run. What are you, like on the third generation or something? And I see $1 billion in sales, potential $1 billion in sales, I should say. And it's not like you're selling, high-end goods or anything. I mean, it's iced tea, for more or less here. And not to belittle that, but I am just curious as to how you got from your grandfather 80 years ago, starting up this business, to potentially $1 billion in sales in the next year and a half.
Well, thank you. Milo's really is that great American growth story. We have doubled in size 3.5 times in the last decade. And as you know, we're a tea, but we're also a lemonade company. But it didn't start out that way. My granddad, Milo, came back from serving our country in World War II, and he and my grandmother, Bee, opened a hamburger restaurant in Birmingham, Alabama. Many, many years later, they noticed people would drive through just to get the tea. And so our family figured out how to put it in a jug and sell it locally in retail. And fast forward, today we have 9 flavors. We're in all 50 states and over 55,000 retail locations. But what we're really proud of is that we're still 100% independent, we're 100% family owned, and we're still growing in the double digits.
I am curious about sort of how you look at your consumer. We talk a lot on this program about whether consumers not only have the money to spend, but more importantly, whether they're willing to spend the money, assuming they have it. And I look at a product like yours. Does that fall into sort of the, consumer staples category, or is this just a treat? Is this something more discretionary that potentially people would pull back on in the event of an economic downturn?
So Milo's has the best fans out there, and I can tell you that, we are seeing the consumer making different choices at the shelf, trading down, or sometimes not even purchasing, but they are continuing to stay loyal to Milo's. And I really think that's a testament to what my granddad taught me, and that is, you always listen to your customer, you never sacrifice taste, and you use real ingredients. And that vision still guides us today because our teas taste different. They taste like homemade because they contain real ingredients you have in your kitchen. So what we like to say is that we're offering premium product at an accessible price for every consumer in America, and that's certainly proving itself as we are looking at consumers making different choices at the shelf.
We've seen so many brands, water brands in particular, but lots of fizzy drinks and non-fizzy drinks brands get acquired, in fact, by some of the bigger consumer staples and consumer discretionary companies. Have you been approached?
Certainly people call all the time in order to talk about that. You know, we've made a commitment to be a family-owned company. We believe that you can really focus on generational opportunities when you are looking at through generations and not just what's going to happen next quarter. So it allows us to focus on things like sustainability, big thorny questions. We really are very invested in our people-first culture where we prioritize people before profits. And by the way, that adds to your profits because when people know that you care about them, they're going to work their, you know what, off for you.
Yeah, I saw you transported 120,000 bottles of Milo's to San Antonio after the Texas flooding, and I was quite impressed. I am curious, though, you're everywhere, right? You're in Whole Foods, you're in Shop and Stop, you're in Walmart, all of the major sort of distributors. Where is the next stage of growth for Milo's?
So our next stage of growth is innovation. There are a number of other categories and flavors that we think we know our consumers are asking for, and also channel expansion. You know, we have a lot of opportunities in food service and in, you know, even outside the U.S. So we are a 79-year-old startup that is just getting started. And, you know, as you noted at the beginning of the segment, we have the playbook. You know, we've doubled time and time again, and so we really feel like we know what we need to do to get to that $1 billion. And it's really continuing to execute on our core, being true to who we are as a brand and as a company, and showing up authentically like we do with our real ingredients and for our fans and our customers.
With regards to those ingredients, I mean, what is your sourcing, your supply chain looking like when it comes to cost and when it comes to maybe the potential disruptions that we've been seeing from tariffs and other trade-related issues?
So we're making every effort to source all of our ingredients domestically. The reality is that some natural resources are not domestically available. We are able to source, like, for example, our pure cane sugar. It's all grown here, it's processed here. But when you look at our tea, there isn't a domestically viable source for our tea in America. So, you know, the overall industry, the consumer packaged goods industry it's 10% of the domestic manufacturing jobs in America. And, you know, we as an industry are sourcing 90% of the inputs, the ingredients. They're grown, they're produced, they're manufactured here in America by American workers. Yeah. But there's simply just things you can't get domestically.
What about the packaging, like, you know, the plastic bottles and everything else that goes into getting that into store shelves?
At this point, we have not seen any changes from a tariff standpoint on our bottles or any of our packaging. All of our corrugate boxes are made from 100% recycled material that is, you know, collected here in America and actually produced here in America in a 100% sustainable plant. So it is, you know, we're trying to create this total circular supply chain with things that are domestically available. We just don't have access for certain ingredients.
Tricia, it was great to talk to you. Absolutely fascinated by your brand. Somebody with a big connection to Central Alabama. Definitely rooting for you. Milo's Tea Company CEO Tricia Wallwork there. As we continue here on the close, another mover in the after hours trade, and that is Circle. This is the relatively new entrant to the public markets here. That company is saying that it is now going to have a secondary offering here for about 2 million shares. That is sending the shares down by about 6% here in the after hours trade. There's also going to be another 8 million added to that. So all told, about 10 million shares in this secondary offering. This is the close on Bloomberg. Move over, Taylor Swift. You're not the only one dropping big entertainment news today. You may have heard, Fani, that she's actually coming out with a new album. She declined our request for comment, but we got the next best thing, Duski. The comedian, actor, entrepreneur, and everything in between, the multi-hyphenate, had a chance, came into the Bloomberg studios earlier today. We had a chance to catch up with him and really talk about just how much the entertainment industry has evolved, particularly for someone like him who got to start on social media and is now kicking off an arena tour next month. Take a listen.
I'm actually very excited, man. We've transitioned through a lot of different stages of my career so far, and like being able to say that this is my first arena tour is still mind-blowing. But yeah, no, it's definitely amazing. And we're working on so much, man. We got TV shows now. We have a movie on the way. Yeah, there's so much in store. So
was it always your goal to be a comedian? Was that what you grew up wanting to be?
Yeah, I think I just didn't know. When I was younger, I used to just want to be funny in school. Yeah. But I got in trouble for it. So I was kind of confused early on because I didn't really know am I supposed to be doing this? You know what I mean? Because everybody was painted to be like a bad thing in school. So, yeah, it is amazing how it actually transpired throughout life. I had to figure out what my purpose was, but yeah, nah.
I am curious about just the economics of your business. I mean, we talk about the big Coulda Fest tour, but you have all these other shows, the dating show, the Coulda Fest, the Coulda House show, and I know I'm forgetting a few others out there as well. But you're producing all these yourself, right?
Yes, yes.
Through your own company. So effectively, this is your business.
Yes.
You control it.
Yes. 1,000%. Yeah, 100% ownership. That's what we promote.
Yeah.
100%. No, but there's a reason for it though. Like I know I make the joke all the time, even with Could Have Been Records, that I do enjoy doing it, but I mainly do it for the fans, knowing that I can do it myself, and now that I have money from brand deals and people that I work with in order to do it, it's like I don't need another company to come in, which is cool. I do enjoy that, but I think building my own IP in this area is probably the most strongest thing that I enjoy developing.
In the process, from when you started to where you are now, were you ever tempted to maybe sign or take a job with a bigger company?
Well, there's some deals out there I'm still tempted with. But I'm not saying it's not out the picture, but the main thing I did start doing my own shows and giving it for free on YouTube was because I wanted to build something bigger by myself first. And then, as things happen, we have a lot of stuff coming up that will be with other companies as well. But yeah, no, I think I just wanted to build out my IP, and I looked up to, the Adam Sandler story of how he built up Happy Madison and just all his movies and his production company. So I wanted to do the same for mine.
When you look at the opportunities out there for the next Duski, whoever that may be coming up, do you think that path that you took will still be there?
Yes. With social media, it's moving so fast, and I think so many people are starting to find out that they can do it themselves, which is why I pride myself on what we have done. I hope others will follow that same process and know that if you are getting money from these companies, don't just think that you have to go buy a car or go buy a big house or go just splurge your money. A smart thing you can do is try to build your own IP and try to build your own business around you. So what I would do, let's say Nike, we work with Nike. So if Nike gives me $1 million check, I don't go and put that in my pocket or try to go get a bunch of cool stuff. I'll go and try to spend that money on one of the episodes from my TV shows. And where it may sound crazy, but that money never goes just straight into the pocket. I try to always reinvest.
it. And you mentioned Nike. I mean, you've had a lot of brand partnerships, Beats by Dre, Nike, Raising Cane's, Mountain Dew, Google Pixel. I'm probably forgetting a few others.
Monster and Prize Picks is one of the good ones.
Wow, and so they all came knocking on your door. Why? Because you're so popular? Because you're always out there?
It's not just, I don't think it's always about popularity. I think they may feel like I have that pull on this next generation. Not to brag, I'm not a big bragger. I'm just saying I do think I also bring a good entertainment level to the brand deals that I have, being that we could do commercials on TV or commercials for social media, and my fans they adapt to it. They really do go and buy the stuff whenever we drop anything. So I think that has probably worked out the best for me.
I do have to ask you about just the idea of protecting your reputation. And in the context, obviously, for a Nike or Raising Cane's or whoever, these big brands are taking a risk, right? I mean, normally they like to play it safe. They want to make sure that the people they're aligned with aren't going to say, you're funny, but you've had a few jokes, a few sketches that didn't quite land the right way. You got some pushback. So how do you navigate that? I mean, because you're trying to sort of, not be controversial, but be provocative.
Well, I think I think a lot of stuff, and I preach about this, relationships are key. And with comedy, they have to understand that comedy is comedy, and sometimes you do have to walk that line of what's funny and what's too far. So I think with having a good relationship with some of these brand partners or some of some of the higher ups in that company, they understand okay, this is fine, and we trust him in this because we know this is how we found him. So being able to have these conversations with some of the higher ups of these companies, it's okay, they do have a certain sense of trust that, okay, this is Duski and this is why we love him. So we can't cut ties because maybe we see a skit was too far, or maybe this joke was too far left. So it's worked good just off of just having good relationships with majority of the people that we work with. Yeah.
I mean, how do you see social media comedy, Instagram comedy evolving?
It's headed in a great direction. I think social media now with just the streaming stuff and like the Twitch world and us getting into that. So now I'm starting to develop even pivoting my content into the streaming world and like how that works. So yeah, it's definitely headed in a good direction though, for sure.
That was my conversation with the comedian and entrepreneur, Duski. I would just want to point out, Bonnie, that last question that I asked him, my son gave me that question. Because I think of all the guests I've had on this show on all the years I've been on this network, this was the one he cared about most.
Oh, I'm sure, I'm absolutely
We could have
sure.
had David Solomon, Jamie Dimon, and Jane Fraser around the table. He would not have cared. Duski,
no,
he's tuning in.
He's
He's 16.
16, all right, okay. Well, you got to admire the business acumen, though. So I hope he's learning, I hope he's not just enjoying him, but also learning from this idea that you own 100% of everything and that you plow money back in when you get it. I mean, you're seeing so many of these YouTubers do that now.
Yeah, they're holding on to that intellectual property and hopefully the cash that goes along with it. When we come back, we're going to set you up for what to watch over the next 24 hours. It could move the markets. This is Bloomberg. Here's what the markets will have their eyes on over the next 24 hours, and it includes another slew of earnings.
Yeah, Cisco will get more read of the demand for AI. Brinker International, that's essentially Chili's, another read on the consumer, Romain.
Yeah, it'll be interesting to see if we see a similar repeat of what we saw with Sweet Green and Kava. Obviously, a slightly different customer there. Tencent and Lenovo also scheduled to report. We're also going to get CPI out of Germany, but back here in the U.S., a lot of Fed speak.
Yeah. Tom Barkin, Austin Goolsbee, Romain Bostic, they're all speaking 8 o'clock and 1 and 1:30.
And we're also going to hear maybe from the president. President Donald Trump is expected to meet with European leaders as well as Ukraine's President Zelensky. This is ahead, of course, that big summit with Vladimir Putin in Alaska on Friday. That does it for us. This is Bloomberg.